Everybody, it is Wednesday, the 9th of December, and the market sold off here a little bit today. As we mentioned midday, it wouldn't be a surprise if we were to break down below the 5-day moving average. I thought maybe we would be held up by this volume weighted average price, but we kind of closed right at it. The more important level, of course, is 363, 364. We're still in a major uptrend on the daily time frame. This is our first down day in a while, so a little bit further profit taking wouldn't come as a surprise or be a negative. Right now, we want to keep an eye on the upside in terms of potential resistance right at that 5-day moving average, which is also the week-to-date volume-weighted average price right now. As long as we're below that, we want to just be a little bit more cautious going forward this week. The NASDAQ, same story. That conjunction of the week-to-date is really kind of right up there with the month-to-date as well. So we saw a little bit deeper selling in the NASDAQ, and it was caught by the volume-weighted average price from the the November 23rd, I guess, low. So for now, we look at this as it came down pretty hard to a prior important level, and if we get a bounce, we want to look at it cautiously because it has the potential that maybe it would lead to something deeper in terms of a correction or pullback. But right now, we don't have any evidence that this is the end of a major uptrend that we've been in. This is why we use stops. Very simple. We get stopped out of positions as they move against us. We see if the stocks reset up, and we look at the market overall and see some warning signs. The Russell 2000 pulled back a little bit here as well. This market still holding above its rising 5-day moving average, but did get trapped by the week-to-date VWAP. The more important level probably in here is at about 185-ish. So if we drift down towards that 185 in the next couple days, it wouldn't be a concern. But obviously you want to have your stops in place and protect the gains that you have accumulated here recently. Semiconductors had a pretty good little sell-off here. It was down 6 points, close to 7 points, and just kind of cascaded lower throughout the day. This is where dip buyers get punished. This is why we don't buy dips. We wait for dips to stabilize and then buy. So right now, where are we? Well, we can take a look at this volume weighted average price, and maybe that would tell us we're still heading down towards 210. The last touch of this volume weighted average price is just lower as well. So intermediate term, short term rather, it's guilty till proven innocent below the week to date volume weighted average price, and now that 5-day moving average, which is starting to flatten out. So it doesn't mean you sell short by any measure. Instead, you look at it and say, are these levels going to provide enough resistance for it to fall back, or can this market rebuild? We've had a hell of a rally. It's no surprise that we do get profit taking after big gains, and the market, I think, is telling us don't be in a hurry to get involved in this idiotic mantra of buy the dip. Wait for evidence instead. Biotechs, as we know, broke out to new all-time highs. They tested the prior resistance here today, and so far that's holding on the daily time frame. It's also these important levels in here. What we have, though, from an intermediate term perspective is, we've got that week-to-date volume-weighted average price that tells us just be a little bit cautious. Maybe we need to absorb some of these gains. The volume-weighted average price from this gap, interestingly enough, and not really a surprise, is where the ultimate low was found so far today, and that is, of course, this prior band of resistance. So if that's going to be the key level to hold. If you're a dip buyer, maybe you bought there, but again, I prefer to wait for actual evidence that the buyers are regaining control before getting involved.